live from the city. This is the High Valuation Code with Matteo Turri.
Hello, everybody, and thank you for joining us at the High Valuation Code live series. We specialize in 12 outcomes in 28 days. Thank you for joining us today, Matteo. Matteo is a valuation architect, and he's the founder of the High Valuation Code and also creator of the High Valuation Triangle. He also published in March his first book, Fail Pivot Scale, which you will be discovering shortly. Matteo, would you like to share a little bit about your background?
Thank you very much, Margaret. It's such a pleasure to be here today. As you mentioned, it's been a special year this year because I've already published the book Fail Pivot Scale, which came after 31 years of experience in finance in different stages, different sectors, from startup to scale up, crisis, exit situation, IPO, M&A. So it's such a pleasure to have created the High Valuation Code and to have everyone here tonight. And thank you very much. Over to you, Marguerite.
Thank you, Matteo. My name is Marguerite. I have had experience pre-deal and post-deal in M&A and have completed 14 transactions, cross-border transactions within the Asia regions across countries like Pakistan, India, Vietnam, Brunei, among others. One of the main sentences we say at the High Valuation Code is that AI is the new electricity and the High Valuation Triangle is your greed. We basically specialize in democratizing valuation by making the business easier and being chased by customers, banks, and future investors. The whole principle behind the High Valuation Code is to escape irrelevance. We say most businesses don't fail, they just never become investable. And this is the time to basically change this approach. Before we go into the depth of the topic, it would be useful to give a little bit of context, especially and specifically looking at macroeconomics. On the graph that you see on the slide, you see the GDP as of 2026 and the projections out of 2030. As of 2026, we are at 100.3 trillion. This is the active global economy baseline. It's expected to grow at a 3.3% year on year, reaching 143.7 by 2030. This is an exponential growth, which also obviously entails a lot of different opportunities.
Okay. So such a great picture we've seen about the GDP growth. Now let's look at what is expected to happen between now and 2075, according to Goldman Sachs and the International Monetary Fund. So we can see there's a big geopolitical change rebalancing. As you can see from this graph, we see three big trajectories, actually four. So the trajectory of Europe is the discontinued line. We can see that it's not the biggest growth in the world. So Europe is expected to just grow to around $30 trillion, while we see an exponential rise of India going from where today is about 5 trillion to 52 trillion. So 10 times increase in GDP. While the USA continues very much its growth, much better than Europe, we can see. So effectively, is moving away from Europe big time, USA. But China is emerging as the first economy in terms of size. So what really we see here as a big trend that is happening is that Asia in general is really for the first time, after probably since we know the history of economics is actually coming to play a much bigger role. while Europe instead is expected really to be pushing the second stage when it comes to this. Yeah. So Europe, the euro area is showing sign of stagnation. So which is a very important observation to be made. And one of the reasons why Europe is expected to stagnate is part of what we're talking about today. Really, we're talking about wealth preservation as opposed to wealth creation. Now, let's now come to public capital markets. The public capital markets, they will change every day. We know stock exchange, the index, they give you different prices every day. So apologies if this figure is not exactly today's figure. But yeah, we're talking about the size of the market capitalization is actually higher than the GDP of the world. So we're talking about $127 trillion. There's a dominance of the USA. And we see the institutional frameworks map these equity flows because they establish transparent, standardized reporting baselines. Okay, so navigating in public markets is not the same as navigating in private markets. So we're going to concentrate today on what's happening closer to us. We're talking about, again, we're talking about democratizing the knowledge about valuation. We're going to come down to what I think is the most forgotten area of our market, which is small and medium enterprises. We see a lot in the news about the stock market. We see a lot in the news about startups. We don't speak too much about the middle part of the market, the small businesses that probably provide most of the jobs in the economy and most of the products and services. I'll start talking about private capital markets now. Let's look at the architectural segment. As of now, which is probably, it's fair to say probably the end of 2025. Obviously, this figure needs to be updated. But right now, we got about $14 to $15 trillion of global asset under management. So this is concentrated across private equity, outpacing public market velocity. Now, this figure, 14 trillions, was just 10 times smaller, 1.4 trillions, with just private equity in 2010. So we've seen private equity market grow 1,000%, according to Okorian, P Insight. So that's massive. That's unprecedented in history. So that's the breakdown we have. We go buyout, we go venture capital, we go real estate, growth equity, infrastructure, credit, and other. Okay. Now this is a process-led transition. It's dealing with this dynamic. Really, the demands really transitioning from what we see in the small and medium businesses, which usually they are ad hoc, founder-led frameworks. So we're looking for a professionalization of these businesses. Yeah.
Now, Matteo mentioned the importance of the private market. Now we're going to be looking at the projections. As of 2025, we estimate that we have 14.05 trillion. This is expected to grow to almost 24 trillion by 2030. This is a significant growth and significant opportunities are coming in. If you look at the table on your right, you see all the different types within the private market, and you see that private equity, debt, and infrastructure are growing almost 70%, some above, except real estate, which is growing at 21%. This is a massive opportunity. Now, this being said, this capital, as it becomes available, it's not going to be spread across everybody the same way. So there's going to be winners and there's going to be losers. And what we want to say at the High Valuation Code is that there is a way to become the winners. Now, what you see here in what we were just mentioning is that there's going to be a quality filter, and investors are going to be looking very, very closely at risk and how they're going to be investing those funds. We can tell that there's three main allocation focuses. The first one is infrastructure and artificial intelligence. Obviously, health foundations are going to be critical, but you also need to have the high velocity software to scale. The second is the predictability of your yield, right? So you want to have strong cash flows, stability, so that the risk is lowered. And the third is your governance. So we're going to be looking at structure. If there's no structure, it's very difficult to grow, and you're going to end up having issues down the line. So if we look a bit more in depth, what we're looking is how you're growing. Is it structure-led? Is the leadership transferable? Is there depth in your leadership? In terms of IP and core assets, do you have everything formalized? Are you properly protected? And is this monetized? You want to have built-in strategic liquidity. And you also want to be having market exposure, how global you are, right? Now, let's look at how this institutionalization works in a practical case study. This is about a hospital bed manufacturer. The manufacturing is around $10,000. But in reality, the lifetime for a customer was 10 million. So there's a significant gap. If we look at a traditional model, let's assume that these beds are sold 20,000 per unit, less the manufacturing cost of 10,000. Your realized yield was only 10,000. But if you think differently and you institutionalize your business, you realize that you could actually have split your revenue to an upfront revenue and then have royalties, which would exponentially increase your yield. So basically, in the traditional framework, there were missing opportunities.
Yeah, what we've seen that is also an important concept here. It's outcome-based pricing. Now, this is where we tend to see a lost opportunity for many small businesses. They tend to sell on price and not sell on value. I always say that when you sell on price, the customer will probably leave you on price. When you sell on value, you will be retained on value. Let's talk about the valuation divergence, perception versus reality. That's a real problem here, because what we tend to see all the time, a concentration of attention on performance, which causes, unfortunately, performance illusions. Performance is not really what many people think it is. Resilience is actually the main, the most important factor here when it comes to judging the performance, because investors, they don't buy just what's happened in the past. They buy what they are likely to see happening in the future. So let's start with the fact that revenue is not equal valuation. The top line volume of revenue without any structural defensibility yield zero premium arbitrage, unfortunately. So what we are saying here is a real important distinction between growth without structure and growth with structure. Growth without structure, it can be actually seen as velocity towards risk. And risk is exactly what investors are using to move away from an opportunity. So they don't consider your business investable. Profit equal investability. Now, trailing EBITDA, when they're driven by a business that, for example, is founder-led, is not scalable. So there are three big questions to be answered when we're looking at bankability and investability. Predictability, number one. Number two is transferability. And number three is scalability. You have to answer all the three questions. And the first two, by the way, they are prerequisite to start a conversation. So we're talking about predictability and transferability. When a company is founder-led, it does fail on transferability immediately. Now, the fact that growth is equal to capital confidence is another illusion. Again, an accelerated expansion without governance is actually the signal of an execution risk, and this is where we see valuation discount all the time. Let's look about the valuation divergence and the premium architecture. What are the value drivers? What traditionally we tend to see, and what is the institutional mandate here? So, for example, with operational risk, we tend to see volatility, founder-led revenue generation, and this problem is actually made worse by AI because lack of professionalization, lack of transferability, lack of scalability will impact very negatively, not just on your valuation, but on your performance against your competitors. So the institutional mandate is actually to look for predictability. So instead of founder-led revenue generation, we want to have system-led revenue generation with the recurring cash flow. Again, answering the same question as we said before, it's about how predictable you are and how transferable as well. Now, let's look at asset transition. Here we go, the usual problem of a single point of failure when you go key-man dependent operational network. Instead, the mandate is transferability. It needs to be process-led, not founder-led. Let's look at strategic leverage. What we tend to see as a failure is single outcome commercial pathways. So for example, too much concentration, insufficient revenue line generation. What we tend to see is that what the institutional mandate is optionality. So you want to build in pathways for strategic execution. So this is the word optionality is the exact opposite of the word dependency. Remember these two words: optionality, positive; dependency, negative. And when we look at risk insulation, we see high exposure to market volatility, to systemic risk, and the downside protection here is we tend to see, as is an institutional mandate. Of course, we tend to see a risk asymmetry as a main objective, but we want to really see businesses, really having risk register, for example, proper risk management processes in place, an insurance program, for example. Okay, this is the great capital shift, okay? The relevance of intangible economy. Now, today, well over 90% of the value of the S&P 500, on average, originates from intangible assets. Okay, so we still have the legacy model where the wealth is generated was actually guaranteed by factories, property, inventory. But today we got something completely different. Today we have algorithm, we got data, and we got IP, and so we got this intangible model, which really is the new model. That's the reason why we are today, because in AI-driven economies, we tend to, what we see is an unprecedented ability for businesses to create new assets through AI, identifying, codifying, protecting, and commercializing intellectual property. Value is no longer what you own, it's in what you know. And when earlier on, we were talking about why some economies are advancing, for example, India, China, and other economies like Indonesia, Nigeria, and other economies are unfortunately not advancing like Europe, is because Europe, for example, tends to really stick a lot more to the legacy model then to the new model. Just think about the last 50 years, how many European businesses are able to match, the power of US businesses like, Apple, like Microsoft, like Amazon. So that's something that, we all have to really think about when we think about the difference of performance now and in the future of the last 2 decades and the next 2 decades between, for example, Europe and the USA. That's really an important point to understand. Yeah.
So far, we've discussed two main shifts, macroeconomic shifts. We introduced the larger access to capital coming primarily from private markets. Matteo just covered the relevance and the increasing relevance of intangible economy. And the third is it's basically what everybody has been talking about, and we're talking about AI. AI is a very powerful tool, but unfortunately, a lot of founders see AI as just a tool that they add up, but they don't really realize the impact of it. AI has a very positive impact because it accelerates upsides. So it accelerates speed to market, pipeline velocity. It has capabilities to keep on growing and optimize organizations and systems. However, it magnifies the weaknesses. So if there's any operational crack or friction within your business, it's going to be not only magnified, but it's also going to be exposed. The third element is that AI without structure is basically, it's going to expose the flawed organization and it's not going to give the benefits that are expected from AI. You basically need to remember that AI is an enhancer of positive and negative, but it makes everything more visible. If we look at what the reality is, Gartner has estimated that around 40% of AI initiatives will be cancelled. This is based on an industry analysis in enterprise agent projects. The reason, and let's look at it, what are the three main reasons of why is this happening and why this prediction is so impressive, massive? First, it's because there's an unmanaged cost of scaling. So they're basically integrating agents with an unmapped legacy software. So they're just basically layering up solutions without making sure that everything is structured and everything's talking to each other. This initiative, or lack of initiative, is going to end up inflating costs by 2 or 3 times. The second is the agents washing deficit. So using standard chatbots and rebranding them as agents, although they will not be able to perform the complexity of the tasks that are expected. And the third one, which according to me is one of the most relevant, is the lack of governance. So organizations deploying black box agents without really realizing the potential risks to their organization and what are the upsides and downsides of them.
Okay, so maybe I would like to intervene about telling you about the origin of the High Valuation Code. You can see here a picture of 2017 when we had the first pilot with the University of Plymouth. Originally, this was designed for Plymouth University really to build a recipe for entrepreneur, really translating the desire for many entrepreneurs to have, to be chased by banks, by customer and investor with a program that would effectively give them the right recipe to create wealth with financial intelligence. So this is the real goal of the High Valuation Code. It's not just to give you a good measurement about what's your business worth. It's a journey. It's a journey that starts from where you are today, you start creating assets, creating wealth, and now, especially in AI-driven economies, and the valuation is just the measurement. So the name high valuation is because obviously we are aiming for a high valuation. Now, let's talk about engineer financial intelligence. So it's a systematic framework that prioritizes really not ordinary wealth creation. We're talking about exponential wealth creation. So we're really shifting founders away from basic accounting to really an intention to multiply the wealth and the valuation. So the founder to investor synthesis, but really we design really for the transition to high growth teams into clean institutional grade assets that really they can be chased by investor through exit multiple. So from 2017 until today, then we got a framework that is now has become a system effectively. The system is based on 12 outcomes that we'll see later on. And each outcome has its own valuation multipliers and its valuation killers. So the goal is quite simple. We want to eliminate the valuation killers, and we want to make sure that we adopt valuation and wealth multipliers. So what's the principle about the High Valuation Code? The principle is that markets allocate really to structure. Market don't really reward you when there is chaos, when there are no proven story. It's not about heroics. It's not about how hard you work, how many late nights you spend on your business, really. It's about really what transferability, what scalability, what predictability your business is able to offer. Because manual workaround, just they don't scale, the operations, they don't scale. And when we see founder-led business, for example, without transferability, there's a severe discount. For example, sweat equity that people claim that they have spent, but without an organization platform, that doesn't work, unfortunately. So that's not where valuation comes in. It's not even about growth, because revenue growth without structure is highly toxic in many situations. And it's not about fragmentation, it's about systemization. I always say that a business that depends on a genius is risky, while a business that depends on a system is valuable. So that's unfortunately the truth, So it's not about story. So narrative, they may help you with the initial capital raise, but what you really need is the repeatability of the structure that commands really the right multiple for the valuation. So the market ultimately prices, what we call the truth when it comes to operation. So we're talking about really the ability to produce repeatable result in the future as well. So the high valuation triangle is the framework, and let me tell you what the mechanics are. Back in 2017, it's almost like reverse engineering what investors and banks want from businesses, and creating a framework that would be the foundation for the system. We always say that AI is the new electricity. Well, we would like to say that the high valuation triangle is the grid, because let's face it, artificial intelligence, let's just make a comparison between artificial intelligence and electricity. Electricity without a grid is actually very dangerous, because it can actually cause fires, it can cause injuries, it can cause all sorts of trouble. when you use a grid, electricity will travel and will work well, will be profitable. So why should the high valuation triangle be your grid? Well, let's examine all three sides of the triangle. The first one is intellectual property. Intellectual property acts as the electricity generator. He answered a very important question right at the start. The question is, what do you own? Okay, so because moving from human knowledge to structure and protected and proprietary assets is really what we want to do. Through intellectual property, really removes the reliance on individual talent. Okay, so it builds really the right moat for the business. So that's the electricity generator. Let's now go to the side number 2, which is succession planning. Succession planning acts as the electricity transformer. He answered the question, does it transfer value? And this is where we see a change of identity needed in so many businesses, from startup to scale up. They had to transition from founder-led operation to process-led system. So this is where the transferability question becomes really, really fundamental, and it becomes a prerequisite for any conversation with investors. Now let's come to the third side of the high valuation triangle, which is global markets. And we can compare this to the transmission lines for the electricity. So he answered a question, does it scale? Because let's face it, electricity that doesn't travel is not useful. So electricity that stays in one place will not be economically what you really want to achieve. So this is where we see at the high valuation triangle as your grid so that you can actually profit from artificial intelligence thanks to this structure. I'll go a bit further on this, actually. Sorry, let's go look at the 5 phases. Many people asking, okay, what about startup, scale up, stagnation, crisis, and exit? Yeah, because this is where we see different behaviors. I was saying before about the change of identity needed between startup and scale up. In startup, intellectual property tends to be the biggest part of the triangle, because that's where you have to build the business from concept to validation to development and to deployment. Yeah. And usually in succession planning, we don't tend to see a lot of results because we tend to see founder-centric execution. And global markets, they're really theoretical when you're still building your intellectual property, or you're codifying, you're making it commercial before making it transferable. Now, on scale-up phase, we see the IP must have been already formalized, protected and productized effectively, so that it's made commercially viable and also eventually transferable. Well, when it comes to succession planning, we see that a big change is needed from founder-centric execution to effectively build up of a leadership team. So we see the first layer of management that appears, and then we see global markets that starts to come through. Now, with AI-driven economies, what we see is a major new trend and a major new requirement for many businesses. They have to think global much earlier than they used to do before AI came into place. Why is that? Because AI is effectively breaking the borders and is breaking the barriers that existed before when it came to actually embracing global markets. So today, it works in both directions. You can access global markets much more easily, while your competitors that probably you didn't think existed, they can come into your market and really threaten your position. That's why AI adoption is fundamental for many. That's why at the beginning of this presentation, we said create exponential wealth, do not remain irrelevant. Okay, so that's fundamental. Then the other phase is stagnation, crisis, or exit. We'll see a development of the various parts of the evaluation triangle. For example, in stagnation, we don't see IP as under leverage. We tend to see leadership bottlenecks emerge in stagnation. And in global markets, either global expansion stall or actually is not really as executed as it should be. What we tend to see is, in case of stagnation or crisis, a return to intellectual property as a major opportunity to restart the business, to relaunch the business. We've seen it happening in so many big situations, so many big American companies. They went into stagnation and sometimes in crisis, and they came back to the high valuation triangle through the intellectual property. When it comes to exit, the IP is the valuation driver, effectively, because buyers will always pay for what IP can offer, which is what you own: defensibility, predictability, scalability, and succession readiness is fundamental, because if you do not have succession readiness, the business is not transferable. So on exit, you will not be able to get the right price, or maybe you will never get it, because in some situation the business could be actually deemed, in some cases, actually to be worthless if it is completely dependent on the founder. And then in global markets, we see the global reach can really help multiply valuation. We see that normally global markets are executed when obviously a very strong national position in local markets has been built, and usually through IP monetization strategy that can vary. There could be partnership, joint venture, there could be distribution, there could be licensing or even franchising.
So Matteo so far covered all the 5 phases of business, but he also explained how the triangle changes according to each phase. In the next 5 slides, we're going to cover basically the traps for each of those stages. In the startup phase, the primary, let's say, failure point is market misalignment and capital depletion. What tends to happen is that founders, they haven't really mapped the market fit, and they have weak foundations. The result is that capital, or the pre-seed capital that they had, is going to be depleted, and they keep burning that capital, and by the time they need it, it won't be there anymore. The second is the commoditization risk. So basically building an offering that is not defensible. It's not differentiated. It's basically, there are other providers in the market that offer exactly the same things. This eventually will end up leading to problems. And the third one is, because we already mentioned that the seed capital is burnt in as the first trap, it's very difficult for a founder to find investors. They're basically trapped in this like founder hustle. In the second stage, which is scale up, we have basically 3 main traps. The first one is the operational bottlenecks. So what tends to happen is that the revenue scales outwards, as you can see on the on the graph, but it hasn't been institutionalized or structured. So the founders tend to have a lot of operational bottlenecks due to manual adjustments, lack of infrastructure. And as they grow, that structure is not there to support the volume, which will end up in problems. The second mistake or trap is the hiring mistakes. They misallocate capital, and they end up hiring people that are not exactly what the business needs. And so that ends up basically in a capital burn. And the third one is the poor market expansion strategy. What we mean by this is entering markets without the right information and without the repeatable structure that will enable them to grow. In the third stage, which is stagnation, you see that the graphs that basically the lines grow in opposite direction. The first one we're going to have is, or the first trap is market saturation. So basically, it becomes more and more difficult to acquire customers, to retain those customers, and so you lose momentum in the long run. The second trap is the loss of competitive edge. So using legacy operational setups that basically make you lose efficiency and make you look like everybody else, basically. The third part is your multiple compression. So capital markets would aggressively discount when you look for a loan or when you're looking to have a discussion with investors. The reason for this is that the risk or the perceived risk for the investor becomes higher and higher. In the fourth stage crisis, what tends to happen on the main traps is debt reliance. Because you didn't, you basically burned the cash flow, you will look for external capital and you will basically start relying on debt. So you're over leveraging and you're becoming rigid. This is a very red flag for investors when looking at a business. The second pitfall is founder burnout. What tends to happen is because there's no structure or there wasn't any structure and everything was done around manual turnarounds and adjustments, basically the company grew on effort. And that cannot sustain the volume. And eventually the founder is going to become tired and won't be able to cope with the rest. While he's busy doing the operations, he's not looking at his strategy and he's not looking at how to make his business grow and evolve. The third pitfall that we see is the legal and compliance issues. Because of all the situations that we stated in the past, you will have emergency cost cutting. And the first thing that gets compromised is the international regulatory safeguards, which could end up in lawsuits, could end up in further issues down the line, and obviously further capital burn. The last stage, which is a stage that's usually exciting and feared a bit at the same time, we're talking about the exit. We have 4 pitfalls. The first one is no exit strategy. So basically you've been operating on the day-to-day and you never really prepared at lowering risk and at institutionalizing your business to get the best benefit of it for an exit. It would also make, without preparation, you become less attractive in terms of an acquisition. Under valuation, as I said, you become less attractive, so you're going to be having a higher discount because you basically are perceived as risky and you don't have the right metrics. The third pitfall is basically no buyer interest. So there is no interest and it's very difficult to find a founder. This again, it's the rules of supply and demand. If there's no demand, obviously your price will go down. And the last slide, or the last pitfall, is the regulatory and tax issues. Leaving compliance and IP unmapped, unformalized, it's just it hides very, very high liabilities when it comes to an exit. You might have either penalties in tax or the premium that you thought that you would be obtaining is actually burnt in fines or any other fixes that are required for an acquisition.
Okay, well, let's look at the difference between the legacy state and the target architecture now. So Margaret has driven us through all the 5 stages and what happens. Now let's look at the state that most businesses are in, which is founder-centric and reactive operational risk, as opposed to what we really like to achieve, process-led and engineering evaluation architecture. So what do we tend to see in the legacy state? We tend to see, for example, finance as a reporter, not really as a valuation designer. So we tend to see really accounting function that they just operate in reporting historical fact, effectively documenting past performance, and they don't tend to really drive or influencing sort of the value of the business at all. So tend to have reactive finance. So the strategies that are really important, they are reactive. They are driven by, for example, what cash flow problems we have today. And so what market fluctuation, instead of planning, instead of really establishing a growth that is actually institutional, then we tend to see founder-centric risk. Founder-centric risk, when we see the founder as a single point of failure. Now, this is becoming a bigger and bigger problem in AI-driven economies, because without professionalization, without process documentation, AI has got nothing to scale. In actual fact, AI has a lot to destroy, because if you implement AI in an organization which is founder-centric, where every decision depends on a founder, you will see the opposite result compared to what you desire. So you would have desired AI to scale your business, you're going to see completely the opposite. Now let's look at the target architecture. So where there's for example, a valuation architecture, where financial systems are really helping the business to make decision, for example, because they are engineered as an active grid that will always anticipate issues like cash flow and also valuation metrics as well, of course. Yeah. And we see that in this target architecture, every commercial milestone, every pivot, every decision is really driven by by what system are really helping you to establish as a decision, as an outcome. And usually in this target architecture, there's price for 3 big things. One is confidence, second is scarcity, and third is control. So this is where the enterprise will move into a clean process-led asset. And that will the consequence of that will be exactly what we want: high valuation for the business, high valuation multiple for the business. Yeah. Let me introduce the 12 outcomes. So we've spoken about the high valuation triangle, which is the framework. The 12 outcomes are the system, effectively. They are what create the transformation from before, as you can see to the left, to after, as you can see from the right. So before the transformation, you're hard to fund, you're depending on the founder, you got a cash flow that you cannot predict very well. You have risk that you have not identified. You have pricing pressure, maybe because you have not developed the outcome-based price, for example. You're chasing investor all the time, and you have a low valuation. The transformation of the 12 outcomes will give you a totally different situation. You'll be investor ready. The business runs without the founder, so you create transferability. The cash flow is predictable, because most of the outcome that you will see are will create cash flow predictability. I would add one point about predictable cash flow. It's really underrated as a valuation factor. When your cash flow is predictable, your investor will pay you a premium for that. Now, the risks are eliminated, although I should say there's a risk register effectively. So the lack of knowledge of risk is eliminated. Pricing power is high because you're selling on value, you're not selling on price. So this is where capital comes to you and you can enjoy a premium valuation. So to the bottom here, you can see the transformation. You want to see from reporter, reactive, founder-centric, discounted, to valuation architecture, strategy, investor-ready, and premium valued. So we'll come back to 12 outcomes in a minute, but you can see this is the picture that we have created. And we've also created the high valuation bridge, which we will see in a minute. So we'll start with group 1 and 2 here. So what are the 12 outcomes? So the 12 outcomes are divided into 4 groups. Each one of them is got 3 outcomes. The first group is fundability and value foundation. So the goal is really how to make your business bankable, not just amiable to capital, but really bankable. So when you go to a bank, you know exactly how you can be able to get funded. The second outcome is master the 5 layers of IP. So really it's about transformation. Now, the 5 layers of IP are fundamental to create predictability, which is one of the main requirement to have a high valuation strategy. Revenue without you is where you ensure that the revenues no longer depend just on the founder, but they start to depend on process, on system. The group 2 module is about AI, cash flow, and risk management. Now, this is intentional. Group 1 comes before group 2 because before you monetize your AI, you really have to understand IP. There's a world of difference between AI IP and AI usage. It's a big difference between using AI, owning AI, or I would actually go further. I would say you're renting AI or do you own AI, okay? So we have moved from basic tools and prompt to price system outputs are written here. But that's because, it is not about using ChatGPT or Gemini or Claude. This is about AI inside your business, really generating wealth through asset creation. Then we go to build predictable cash flow. Again, there's the reason why build predictable cash flow comes after the master the 5 layers of IP and the revenue without you, because first you want to build the IP and the system, and then you build predictable cash flow. Risk asymmetry. Now, why is risk asymmetry a later outcome than, for example, becoming bankable? Because that's exactly, after you become bankable, you become risk asymmetric. So you ensure that you are able to identify and manage the risk, but at the same time also identify and manage opportunities. And the biggest opportunity we're talking about today is how do you create asset through intellectual property and AI.
Model number 3 is about scaling, capital, and resilience. This is again separated in 3. The first one is creating your pricing power. So really understanding whether you're competing on price or not, and focusing on creating premium value so that you are differentiable to your competitors. The second is engineer your capital strategy. This is all around understanding and balancing debt, equity, and corporate control so that you become defensible. And part number 3 is scaling your leadership. Basically building high performance teams that can scale beyond your founder dependency. We've moved from the founder dependency, but now we need to help you get surrounded by the right people that are going to enable the founders to focus on the strategy and the vision going forward. The model number 4 is all around going global and attracting capital. The first part is going globally relevant. So how to design your business to be international so that you can scale and avoid all the traps that can be along the way. The second part would be systemizing your operations. It's all around building processes without those manual adjustments, without, and more importantly, formalizing those processes is a very, very important requirement. And the last part would be on attracting capital. So how to become a magnet so that you are attracting that private capital that is going to become available in the next few years.
Okay, so this is where we see the transformation, the result of the transformation on a particular business where a scorecard is completed. We call it the high valuation score, and we see the potential of the high valuation breach and obviously the high valuation code with its 12 outcomes. So we see our business with a sample. This is where we got an illustration about 2.25 million pounds valuation. So indicative of the scorecard that we receive from the entrepreneur. We can see how the various group, the fundability, intelligence, scale, and premium can actually contribute to with the implementation, with the right implementation, to go from a low multiple to a high multiple. So we can see a big transformation here from 10% recurring revenue to potentially 40-50%, and from 90% founder dependency to a target of less than 20%. And that results in a highest multiple, higher revenue as well, by the way, because when you monetize AI, when you understand the 5 layers of intellectual property, you then start to really increase the revenue as well. So the multiple is applied on higher revenue and higher EBITDA than previously. So yeah, this is what we like to achieve, and this is achievable depending on businesses. It can be achieved in 6 months or in 6 years. It does depend on each business. So at the moment, this transformation is happening in Europe. So that's great to see. So what's the typical implementation program? This is an example of a 6-month Gantt chart where we see 5 phases. The first month is about discovery in this particular situation. The second is about building. The third one is the month 3 and month 4 is about implementation. Number 4 is about optimization, and number 5 is about institutionalization. Now, this is where each business is unique, of course. This is a tailor-made program for a specific business. We can see the 12 outcomes with the 4 groups interacting with each other. We can see how the logical order is followed. Say, for example, you monetize AI only after you have studied the commercial IP, master commercial IP, for example. We see the building predictable cash flow is preceded by revenue without you, because revenue with the founder-led is not predictable, for example. So we can see the pricing power comes after you've done both IP and AI monetization. And we can see the capital strategy comes after you eliminated risk as well. And scaling leadership is an outcome that comes after you've dealt with the founder-led dependency, effectively. So scale leadership is very important to achieve a high valuation. If you're a founder and you're thinking that creating leadership will cost you money, think again about the benefit of wealth creation and valuation, bankability and investability as well. And also about how you implement AI, because you're not going to be able to implement AI with a founder-centric business where nothing is documented and AI is got nothing to scale. So this is where the investment in leadership will fundamentally change the wealth creation process, as well as the measurement, which is eventually valuation. So normally we tend to see businesses go globally as a last, and for sometimes in some businesses, go globally could be years away. In this particular case, the business was already globally present, so it needed just a few months to improve the strategy around being global. And then systemized operation is the consequence of number 3, revenue without you, and also monetize AI, which will really help to systemize operation as well as master commercial IP. So again, there's a logical sequence about these outcomes, and these outcomes, each outcome has 12 valuation killers to eliminate and 12 wealth multipliers to introduce or to improve. So in total, it's 144 points where you can win or lose effectively the High Valuation Code. And so this is where the system has evolved. And we're very, very happy to announce that this program has been embraced by a corporate finance business in 8 countries. And we're also collaborated with a post-mergers and acquisition organization that is present in 35 countries. Now, let me tell you about the CFO role, because I myself have been a CFO for the last 19 years. So CFO as the anchor of the investor alignment. So now the legacy role was CFO as a reporter, as a historian. Today, the target state is CFO as a valuation architect. Okay, so and we're talking about valuation architecture. The architecture is built brick by brick with wealth creation. And AI is able to play a very big role in creating wealth brick by brick through valuation architecture. So just to summarize here, we can see that the legacy role of the CFO, historical reporting, compliance, just explain what happened, just historical comfort is moving into capital architecture, optionality design, risk asymmetry, which is a very important aspect of how you deal with risk. You know, you don't just defend you against the risk, but you also tend to maximize opportunities, and valuation control. So this is where we see the CFO role has already changed. For all the CFO are participating today, feel free to comment and tell us how you see your role changing too.
We've discussed a lot of all the potential changes and the opportunities that lie within the High Valuation Code. Now, there is a significant cost to delaying. We said that obviously risk and valuation are linked. The more risky your business is perceived, the lower your valuation is going to be. And by valuation, we mean new customers, access to capital markets through banks and investors, or a potential acquisition. we can spread this in three main pillars of why it's so costly to delay. The first one is decisions that are deferred, they become risk. If you delay setting up the structure, it's going to become a potential issue to grow, to gain the volume, and to have operational leverage when you want to engage with capital. The second part is the structure ignores becomes a discount. If you don't have the structure, you won't be able to get the volume. And you're going to end up being or having manual adjustments. Those manual adjustments, they cannot be scaled through AI, and they basically are going to be exposed as part of the due diligence and will end up in discounts. The third is that optionality delayed becomes dependency. With the whole conversation that we have had so far, we're talking about limiting founder dependency, creating independent teams, having that leadership depth. But if you avoid that capital strategic planning, you're gonna stop acting proactively, and you're gonna start acting defensively, which is gonna hinder your business down the road. Basically, what we're saying is that markets reward architecture. We would love to hear how everything we covered today has changed the way you see your business. And if you have any questions, please do not hesitate to type them. We will be replying to each and every question, both Matteo and I. There's also the opportunity to fill in our scorecard. You can scan the QR code on the slide, and we will also be putting the link within the comments so that you can get access. That will give you a first diagnostic of where your business is at the moment, and it is for free. So please do not hesitate to fill in the scorecard and get in contact with us. Matteo, would you like to add anything?
Yeah, what I would like to say, I'm going to put now the link of the scorecard into the comments, so you'll be able to fill it in. Now, this is free to fill up. What you will get is an initial diagnostic about where your business is compared to those 12 valuation outcome, and even more importantly, we're talking about the 144 valuation killers to eliminate, as well as 144 wealth multipliers to implement. So yeah, it's really precious, this scorecard, because I've been speaking to quite a few founders over the last few days and weeks, and I can see how important it was for them to find out about their position. I would say this, most of the time, we decide not to go ahead immediately with those founders, but they found it very, very useful because they think back about what they could do with the funding of this scorecard. It's really, really precious for them. So I would highly recommend that you take a look at this. There's no, as I said, it's absolutely free to do that. We will take the time to reply to you with a diagnostic, and we will invite you to a 15 or 30 minutes conversation where you'll be able to see, because what happens is we elaborate the diagnostic, and then because the volume that is of the information diagnostic is quite a lot, we tend to spend our time, just giving you the right feedback. We don't just want to give you a result that has not been well analyzed. Yeah. So we don't ask you for financial statement or anything like that. We just ask you to answer some question, and depending on when you answer those questions, very much you answer them as a true format as possible. You will find valuable insight about how your business could scale, how your business could eliminate those valuation killers that we all want to eliminate, how you can potentially create exponential wealth by creating new assets thanks to the intangible economy. So this is where we see lots and lots of opportunities for many businesses to adopt really a AI-driven economies, the intangible economies. As a real thought about this event, I wanted to say this. Since I personally created this program in 2017, I can see how it has become even more precious because the intangible economies have continued to advance, but at the same time, we can see how AI is now rewriting really the rules of valuation, rewriting the rules of how productivity is made, and creating assets through AI has never been easier. So, and actually creating new intellectual property never been easier, never been faster. So I would highly recommend take a look at this. I'm now putting in the comments as we speak the link to the high valuation score. It will take you probably 10 minutes, 15 minutes to fill up. And we will take the results and we'll get back to you with a diagnostic. And we will advise you about what could potentially be a result for your business if you decide to implement those 12 outcomes. We could take a view that, for example, your business might need 6 years instead of 6 months to achieve certain situation. But that's what we will discuss with you after you fill up the scorecard. But actually, I wanted to ask you a question, Margherita. What was the reaction that we saw when we saw the first score completion? That was quite a game changer for the founder that we spoke to last week. So I think it's important also for you to tell your because obviously you were not there in 2017 when I started this, but now you discovered in the program in your own time.
Yes, absolutely. As soon as the founders, they fill in the scorecards, and then there's generally a state of surprise when they see the results, but they also see that there's very actionable action plans. So it's very concrete and it's practical. So they see a timeline, they see how the business can evolve and the potential it has. And building for valuation is not something that should be done last minute. When you are thinking about an exit, it's too late. It needs to be done from the start in order to reduce the complexity. As the business grows, it becomes harder and harder to set up that structure because of the complexity and the effort that will be required. Well, and if it's done from the start, it's just basically building for success. Yeah.
The other thing I would say is that the word valuation tends to be exchanged for a financial event. Valuation is something you engineer, you design every day. Valuation is not something that you discover just when you want to do a calculation. And valuation is just a measurement, because what you're really looking to do, especially in AI-driven economies, is to create new asset through AI after obviously following the 5 steps, the 5 layers of intellectual property monetization. Monetization is one of the 5 layers, by the way. Before monetization, there are a few more. So the right sequence for intellectual property, don't follow the wrong sequence, because when you do that, you may actually risk to fall apart completely your business. So creating asset, creating wealth is what eventually builds the right valuation for your business. And this is where we spend a lot of time with many founders talking about that. We also have feedback from the biggest accounting firms in the world they keep telling us that valuation is always seen as something that is like an afterthought, is thought about too late. So what we are really looking to help you with is not to think about valuation when it's too late. Think about wealth creation now, so that the valuation later will be just the reward, just the final result that you achieve. You wanted to add something, Margaret?
No, it's building now, it's avoiding the stress later, and it's disappointment. Very often, especially when doing acquisitions, and we would finish the due diligence, assess the risks, the founders always tend to be disappointed when they look at how much they'll be getting for the businesses that it took a lifetime to build. And the reason is because they didn't understand the relevance of structure. They didn't understand that they should protect their intellectual property, and all of these 12 outcomes that we're covering as part of the High Valuation Code.
I can see there's a question from Tomek. Tom, thank you very much for joining us today. You are asking whether founders should master valuation, IP, AI during Series E, Series B, and Series C. Now, thank you very much for asking this question, because as I said, most people tend to think about this only when it's too late, when they have to raise capital, when they perhaps it's too late to negotiate the right valuation in front of the investor. Now, the answer is that really intellectual property and artificial intelligence should be part of day-to-day business, really. You should never wait for Series A or Series B or Series C. Now, obviously, if you are looking to build the right valuation for the next round, you want to give yourself, I would say, at least 6 months or maybe 12, by really finding out which asset is unbuilt in your business, because each business on average has at least a dozen of unbuilt assets, and those unbuilt assets, they are prevalent in those businesses that many people think they don't have any intellectual property. I'm talking about professional services, consultancy, all this type of business where we tend to see a vast amount of know-how, which is not structured. Now, think about this. In artificial intelligence-driven economy, what we see is that knowledge is losing value, but structured knowledge is actually going exponential. So it's about transforming knowledge into asset. That's the magic of AI. That's the magic of really creating intellectual property. So this is where, what we tend to see is really a discovery that many businesses are doing. And it's important for all those who are listening to us, all those who are in professional services consulting, to understand this. So yeah, that's important for you to know. So my answer to your question is Series A to Series B, it's absolutely precious, but I wouldn't wait until you get to Series E if you haven't got there yet. I would say, start investigating about the capability of your business, the know-how, the unbuilt assets right now. I guess you wanted to say something else, Margaret. Sorry.
No, absolutely. I entirely agree with you, Matteo. It's something that you need to look at or look for and build from the start. Don't wait till your IP is not protected and then your business is taken over, or you need to prepare it, and you need to prepare it from the start.
Okay. I wanted to say thank you to Abdur Razak. He said that it's a very informative meeting. By the way, Abdur, you are welcome also to elaborate a bit further on that, if you want, tell us about your experiences about valuation. We're always happy to learn from your own experiences. And I also want to thank you, Arun Bhatt. So when your comment is about the many businesses that mistake efficiency for value creation. Yeah, you're absolutely right. You're talking about automation saves time, which is true, but assets create wealth. Absolutely. Automation does not build a valuation as such. It's actually very minimal. So when many people say, okay, well, I'm using AI and I'm basically creating value, well, using AI will not move the needle. Making AI embedded in your business will change the valuation of your business, the wealth creation part of your business. So you also added, Arun Bhatt, that AI becomes transformational when it helps convert one into the other one. Yes, I could not agree more with that. So there's never been a time in history, in economic history, where creating intellectual property has been easier. Intellectual property through AI is something that we all are able to enjoy, and it's something that it should be fundamentally appreciated, and that's what we're here today. That's what the scorecard will do for you. After you complete the diagnostic, we will be able to tell you so much more about that. Okay, so I also wanted to say thank you to Marsha for joining us today. Thank you, as always. Very, very welcome, Marsha Jane. I know you're one of the newsletter readers, so thank you. It's great to see you there. Yes, I would like to thank quite a few people for joining us today, for appreciating Dan Friesland. I would like to thank Marielle Berggraf. Thank you, Arshit Tiwari, for joining us today. And Patrice Dissot, thank you very much. And Sieda Akdus, feel free to ask any question even now or after the meeting. And Azal Moyo, thank you so much. From the USA, James Robinson, absolutely. Thank you very much, James. From Robinson Events Limited. And Sam Mazumdar, Modernizing Accounting Firms. We'd like to hear from you, Sam, really interesting. How to modernize accounting firms for the next decade. It sounds like, we got something to talk about when it comes to intellectual property monetization. Mohammad Hassan, thank you so much. Joel Brody, Ijeoma Chukuva, thank you so much for appreciating this. Cyril Carlos Lopez, Armin Buluma, Session Isanka. Session, thank you so much. I know you've been appreciating so much of the work we've done on our channel. So yeah, keep following us. And obviously, you're very welcome to fill out the scorecard. Also, thank you to Sapna Srivastava. Apologies for those. We cannot always make this with the right time zone difference. I hope those who are not in the right time zone will be able to enjoy the replay. You can watch this any time. Yeah. I wonder if you want to say something else, Margaret.
No, I know a few of you did ask for the recording to be shared. We have a list, so don't worry. We'll get the recording very soon.
Yeah, I would say this. We got a list of people who have really registered to attend. Yeah, I'd like to thank them more. In particular, yeah, also would like to say thank you because we just connected recently to Panevit Prichaban. Thank you so much. Arthur Pineiro, thank you for joining us today as well. Mattia Lecchi, thank you so much. From Italy, United Arab Emirates. Yeah, we've been joined by everywhere in the world, from Asia, from Europe, from USA. So, Dan Friesland, thank you so much. And Mark Club as well. I know we've been speaking lately on LinkedIn, and it's great. Frank Tirelli, thank you so much for your advice. We've been speaking about over the last few days about with your experience. You're a board advisor, so you got so much knowledge about how we could potentially have this system implemented in so many good businesses. And thank you, Domenico Cavaliere from Italy. It's great to have you on board. And Simon Betrus, obviously my co-writer of the Fell People Scale, the book that was published on the 1st of March. And thank you, Pete Lisak. I know, Pete, we're talking shortly on a one-to-one conversation. Thank you so much. Okay, so Odie Cummings, we're going to speak soon. Odie, great work as usual. Thank you for sharing all your work there. So shall we just wrap up and say, over to you, actually, Margaret, first of all.
Thank you, everybody, for joining us today. I hope you enjoyed this as much as we did, and we'll be doing more and more of these events in the next future.
Thank you all, and we'll see you on the next event. And feel free to reach out on a direct message on LinkedIn. If you're watching on YouTube, by the way, you can reach us also on YouTube as well, and so on Substack as well. So thank you so much, okay? And over to the next time. Thank you, Margaret, yeah?
Thank you, Matteo. Bye-bye.
Bye.